Welcome to enrichminds.com and our session on bond yields. Now that we know everything about bonds, we shall turn our attention to mastering yields and to comparing different bonds. Bond yield is the return an investor realizes on a bond. The bond yield can be defined in different ways. Setting the bond yield equal to its coupon rate is the simplest definition. The current yield is a function of the bond's price and its coupon or interest payment, which will be more accurate than the coupon yield if the price of the bond is different than its face value. More complex calculations of a bond's yield will account for the time value of money and compounding interest payments. These calculations include yield to maturity, or YTM, bond equivalent yield, or BEY, and effective annual yield, or EAY. Let's quickly revisit the key bond terms we learned in the last session. Face value. This is the value of the bond to be paid back by the issuer at maturity, say $1,000. Coupon. This is the fixed interest rate that the issuer will pay as a percent of the face value, say 5% per year. Maturity. The date when the issuer is obligated to pay back the principal or face value. Current price. The market price of the bond. It may trade at a premium or discount to the face value. We must remember three things when it comes to bonds. First, the market price of bonds moves opposite to interest rates. If interest rates rise, bond prices fall. If interest rates fall, bond prices rise. Second, longer the bond duration to maturity, riskier the bond, and so higher will be the expected yields. And third, if the coupon rate is lower than market interest rate, the bond will trade at a discount to the face value. And if the coupon rate is higher than the market interest rate, the bond will trade at a premium to the face value. Let's look at the different ways we can calculate yields. First, the easiest is the coupon rate. Here, the coupon payment divided by the face value of the bond expressed as a percentage. Second, the current yield. Here, the coupon payment is divided by the market price of the bond expressed as a percentage. And then the yield to maturity, or YTM. A bond's yield to maturity, or YTM, is equal to the interest rate that makes the present value of all a bond's future cash flows equal to its current price. These cash flows include all the coupon payments and its maturity value. Solving for YTM is best done with Excel formulas. Let's now watch a short video on various bond yields.
Two popular bond yield measures are the current yield and the yield to maturity. The current yield is the interest it pays annually divided by the bond's current price. This calculation tells investors what they will earn from buying a bond and holding it for 1 year. Jane is thinking about buying a bond for $100 with a $10 annual coupon. She divides $10 by $100 to find its current yield is 10%. Since bond prices constantly change due to market and economic conditions, Jane may not really earn 10%. Her actual return will depend on how long she holds the bond and its price when she sells it. Jane might sell the bond after 2 years for $75. While she earned $20 during the 2 years she held it, since she sold it for $25 less than she bought it for, she actually lost $5. The current yield approximates what she might earn, which helps her decide whether to invest. Since she wants to buy a bond, Jane also needs to consider yield to maturity, YTM, which is the anticipated return if she holds the bond until it matures. That is, if she doesn't sell before the maturity date of the bond. YTM is expressed as an annual rate, and it accounts for what all of a bond's future coupon payments are worth today at their present value. Jane needs to know the bond's market price, par value, coupon interest rate, and time to maturity to calculate YTM. She plugs these numbers into a computer program that assumes all coupon payments are reinvested at the same rate as the bond's current yield of 10%. YTM is a complex calculation, but it gives Jane a better idea of her potential returns and lets her compare what she could earn from bonds with different maturities and coupons.
In summary, then, the main takeaways from today's session are: first, a bond can be analyzed in many different ways, and many different metrics are used to compare bonds. We must be careful when investing in bonds and fully understand the risks involved. Second, to be successful in bond investing, we must fully understand the math behind bond pricing. Thank you for your time. Until next time then, stay enriched and strong.